Welcome to the Deep Dive. Today we're jumping straight into CooperCompanies' Q3 results and their outlook. Our goal, to really unpack what happened and what's next for you. So let's get right into those Q3 numbers. Ended July 31st, right?
That's right. And it's a bit of a mixed picture, honestly. Consolidated revenue hit $1,060.3 million.
Okay, which is up 6% year over year. That sounds pretty decent.
It does, yeah. But then you look at the non-GAAP diluted EPS, that's earnings per share, stripping out some one-off costs. That jumped 15% to $1.10.
Sure.
Really strong on the earnings front.
15%, wow. But I saw the CEO, Al White, said revenues were actually below expectations, even while praising margins and cash flow. That feels, well, contradictory. How does that work?
Yeah, that below expectations part is really crucial here. You see, while the total revenue, that $1.06 billion, it was basically in line with what analysts thought, but the organic growth, sales from their core existing business, ignoring acquisitions and currency effects.
Right, the underlying pulse.
Exactly. That was only up 2% year over year. And analysts, they were expecting closer to 4.9%. So quite a miss on that core growth metric.
Ah, okay. So the headline number looked fine, but the engine wasn't revving quite as fast as hoped.
Precisely. Though to counter that a bit, they did nudge up their full-year adjusted EPS guidance slightly to $4.10 at the midpoint. Shows some confidence in profitability, at least.
Got it. So let's break it down then. Cooper has two main parts, CooperVision CVI, the contact lens side, and CooperSurgical CSI, fertility and women's health. How did CVI do? Revenue was $718.4 million, up 6%, but again, only 2% organically. What's the story there?
Well, for CVI, that organic miss comes down to two main things. And the first one is fascinating. It's this internal dynamic. They call it the Clarity MyDay dynamic. Basically, sales of their Clarity lenses dropped off noticeably.
Where?
Globally, really, but especially in Asia-Pacific. Also saw slowdowns in the Americas and EMEA.
Was that competition stealing share?
Not exactly. It seems customers were actively switching from Clarity to MyDay.
Which is Cooper's own premium daily lens, right?
Exactly. And the key thing was they finally fixed the manufacturing problems they had with MyDay. They just couldn't make enough before.
Ah, so the supply constraint was lifted.
Right. So suddenly they could flood the market with MyDay fitting sets, trial lenses, and people jumped on it. It was an internal trade-up.
So like they had this pent-up demand for the better lens, MyDay, and couldn't meet it. Now they can, so people are switching from their other product, Clarity.
You got it. It kind of masked MyDay's true underlying strength for a while.
That makes sense. But does that internal shift worry you at all? Could it still hide some underlying weakness, or is it purely unlocking their own demand? And what was the second factor for CVI?
Good question. It mostly looks like unlocking their own latent demand, which is actually a positive sign for MyDay's strength, shows how popular it really is. As for the second factor, that was significant weakness in the pure-play e-commerce channel in Asia-Pacific, excluding Japan.
We saw that earlier in the year too, right, in China?
Yeah, similar echoes to the Q1 challenges there, but here's the interesting part. It didn't really hurt their profitability much.
How come? Less revenue should mean less profit, no?
Usually, yes. But that specific e-commerce channel, it runs on really thin margins anyway.
Yeah.
So losing some of that low-margin revenue didn't hit the bottom line too hard.
Okay, small silver lining there.
Yeah.
So putting aside the Clarity dip and the e-com softness, what's the positive news on MyDay now that production is sorted?
Yeah, the good news is the constraints are gone. Momentum is building. They're rolling out fitting sets globally. MyDay saw double-digit growth this quarter. And they've even won some recent contracts for private label versions of MyDay. So it's really positioned well now.
And other CVI products, how do they do?
It was a bit mixed. Toric and multifocal lenses, the more specialized ones, grew a solid 6% organically. Good demand there. Sphere lenses, the standard ones, were down 1%. But Miss Sight, their myopia control lens for kids, that's a bright spot.
Oh, bright.
Really bright. Up 23% growth. Had a record quarter in EMEA and just got regulatory approval in Japan. They're planning to launch their early next fiscal year, FY26.
That missite growth is impressive. Shows a focus on those higher growth specialty areas.
Definitely. It's a key strategic area for them, tackling that global myopia issue.
Okay, so that's CVI. Now let's switch gears to CooperSurgical, CSI. Revenue there was $341.9 million, up 4%, but again, just 2% organically. How did that break down?
Right. So within CSI, you've got fertility and an office and surgical. Fertility brought in $137.1 million. That was up 6% or 3%
What
organically,
drove that?
mostly genomics testing and consumables. But the fertility market itself is still facing some pressure.
That was so.
Clinics are being cautious with cash, delaying buying big equipment, and they're still seeing softness in the number of fertility cycles in Asia Pacific.
Okay, so near-term headwinds for fertility. Clinics holding back, Asia Pac slow. How does that square with the often touted long-term potential? I mean, infertility is a huge issue globally.
It absolutely is, and that's why the long-term optimism is still very high. Despite these, temporary bumps, the underlying need is massive. Think about it, the stat is 1 in 6 people globally experience infertility. That fundamental demand isn't going away. It makes the market resilient long-term.
That's a powerful statistic. And the other part of CSI, office and surgical.
That was $204.8 million in revenue, up 3%, but only 1% organically. Strength came from their labor and delivery products and specialty surgical devices. Oh, and they also mentioned a new inserter for their Paragard IUD. Apparently, it's helping offset some volume pressure because they can get better pricing with the new device.
Interesting. Okay, let's move beyond sales. Financially, things look stronger, right? Gross margin up.
Yes, non-GAAP gross margin improved nicely, up 70 basis points year over year to 67%.
Basis points is hundredths of a percent, so a 0.7% jump. And operating margin.
Also expanded. Non-GAAP operating margin hit 26%, up 60 basis points, so 0.6% increase there.
So even with mixed revenue, they're getting better at turning sales into actual profit. What's behind that?
It's a mix of things. Efficiency gains in manufacturing, a better product mix like more high-margin MyDay, some help from foreign exchange rates, and just being disciplined on expenses. And that's why looking at these non-GAAP numbers is so important for you, the listener. It cuts through the noise of acquisitions, restructuring costs, gives you that clearer view of the core operational health. It's what management focuses on.
Right, the underlying engine's efficiency.
Oh.
And they generated strong cash flow, too.
Very strong. Free cash flow was $164.6 million for the quarter, and they used about $52 million of that to buy back their own stock.
Okay, solid financials. Now, the crystal ball time. Forward guidance. What are they telling us about Q4?
For Q4, they're guiding revenue between $1,049 and $1,069 million. That works out to about 2% to 4% organic growth.
That midpoint, around $1.059 billion.
Yeah.
Isn't that a bit below what analysts were hoping for? I think consensus was closer to $1.09 billion.
It is slightly below, yes. They're definitely signaling some caution for Q4. Non-GAAP EPS is expected between $1.10 and $1.14.
Why the caution? What's baked into that Q4 outlook?
Well, for CVI, they expect the Clarity headwinds to continue as that MyDay conversion takes, a couple of quarters to fully play out in the revenue numbers, plus maybe some more inventory adjustments in certain channels. And for CSI, that softness in the fertility market, particularly capital equipment delays and Asia Pac cycles, is expected to persist in the near term.
Okay, so managing expectations for the immediate future. What about the full year then? They updated that guidance too.
Yeah, for the full fiscal year 25, they now expect revenue between $4,076 and $4,096 million. That's 4% to 4.5% organic growth. And non-GAAP EPS for the full year is guided to $4.08 to $4.12, so holding pretty steady on the profit outlook overall.
But looking beyond FY25, they sound more bullish, right? Confident about long-term growth.
Definitely. They believe CVI will keep outpacing the overall contact lens market. That MyDay momentum is key, plus new products coming and those recent contract wins. And for CSI, they expect the fertility market to rebound as those Asia Pac cycles normalize and clinics start investing again.
And financially, what's the longer-term picture look like?
That's where it gets really interesting. They expect operating margins to keep expanding as they leverage past investments. They've also got plans to handle tariffs better, expecting a $24 million lower hit than they thought before.
How are they managing that?
They plan to offset that remaining impact with disciplined spending control. But the big number, the real kicker for you, is free cash flow. They're projecting about $2 billion in free cash flow over the next 3 fiscal years.
$2 billion. Wow. Where's that coming from?
It's largely because CooperVision's big spending cycle, the CapEx for building out all that MyDay manufacturing capacity, is basically done.
The big investment phase is over.
Exactly. So now they can focus on efficiently converting those strong margins into hard cash. And their priorities for that cash are clear: reinvest in the business, pay down debt, and buy back shares. It's a strong story.
Okay, so wrapping this up, key takeaways for our listeners. What does this all mean?
Well, first, remember the contact lens market itself is pretty solid, usually grows mid-single digits thanks to global vision correction needs and better tech.
Right.
Cooper's recent challenge was unique. It was that self-inflicted MyDay capacity issue. That internal trade-up from clarity temporarily hid just how strong MyDay was. It wasn't really a market problem for them, more a supply issue they've now fixed.
And they're actively working on getting more efficient too, right?
Absolutely. They're constantly restructuring, integrating past acquisitions, using IT upgrades, even AI to streamline things, especially general admin costs. It's all about setting up for efficient long-term growth. Getting MyDay production fixed was like a really big swing for them, puts them in a great spot now.
Well, what about pricing? You mentioned that earlier.
Yeah, that's a crucial nuance. Globally, pricing power seems to be easing off a bit. While the Americas still see some ability to raise prices, Asia-Pacific is tougher. So they're estimating maybe only a 1% global price increase next year. That's down from the 2-3% they've managed recently.
And that means
It means they can't rely as much on just hiking prices for growth. They'll need to focus even more on selling more lenses, being super efficient, and bringing out innovative new products. It's a subtle but important shift for you to watch.
so this deep dive shows a company managing through some, let's say, near-term noise, the MyDay clarity switch, Asia-Pac e-com, but also making smart moves internally for the long haul. MyDay, now fully unleashed, seems absolutely central to their growth plans, backed by improving operational muscle.
Exactly. So here's something for you to think about. Now that those MyDay capacity chains are off, and with their clear focus on efficiency and cash flow, how fast can CooperCompanies really turn that strong pipeline and market position into faster top-line growth, especially in a world where just raising prices might not be as easy? It's definitely the key question to ponder as you watch what they do next.